Hello and welcome to CMC Markets Trading Outlook for December the 1st, 2014. My name is Colin Sadzinski, Chief Market Strategist. This week's topic is Santa Claus versus the economy. Historically, December has been a really good month for stocks in what's known as the Santa Claus rally effect. It's been a positive time of year. There's a lot of cheerfulness in the market and a lot of optimism heading into the new year. So some people ask me, do I believe in the Santa Claus rally? Absolutely. Do I believe we're going to get a Santa Claus rally this year? Probably not, or at least not at the beginning. It looks as though we could be in for a really choppy and volatile beginning to December for a number of factors. First of all, we've got stock markets that have already run up a huge amount and they could be getting exhausted. Second of all, we've had a lot of volatility in commodity markets and metal markets, particularly in crude oil and gold over the last week or so. Some of this may continue into December, and with a number of major economic announcements, central bank meetings, and other news, we could still be off to a very volatile start to December. There's so much playing out this week, I almost don't know where to start, but I will start with a few simple things. First of all, I want to talk about the rally in the markets we've had in the last few weeks and the potential that they might continue. We've had oftentimes we do get corrections through the latter part of the summer, and then we see markets rebound in November and December. Well, we have had an unbelievable rebound in stock markets through the month of November, and so one of the questions we have to ask is there anything left in Santa's sack of goodies for the markets in December, or has it all come through already? And I'll start by showing the action in the DAX to show what I mean. I'll just bring this chart up. So look at this. We've had an explosive rally. This down here on October the 15th was down at 83.50. Here at the end of November, we're touching 10,000 again. That's just absolutely explosive rebound, and we've got the DAX quite overbought. So we have to ask ourselves, in heading into December, is there any gas left in the tank? Is there anything left that could possibly drive markets through their summer highs and on to new highs? Similarly, as we look at the U.S. indices, I'll just bring up I'll bring up the Dow as an example here. The same sort of thing. We've had the markets have been screaming at higher late October, early November. As we've gone into December, the momentum's starting to level off a little bit. Perhaps we have enough for another explosive move higher? It's hard to say on what's going to do this, particularly with so many things happening. Global economies slowing. We've seen that impact start to play out on crude oil and work its way into gold and other things, which I'll speak to in a few moments. Markets are starting to look tired here. There may not be enough legs left for another big move higher, at least not in the first half of December when there's still a lot of economic news that could play out. We're overbought on the RSI here on the Dow and starting to roll over. Do we move into a period where we get a sideways correction or an actual downward correction? Remains to be seen. But we are into a possibly volatile period for global stock markets. And some of this point where we may be reaching a turning point in indecision, we can see in our client sentiment. Just in the last few minutes, we've shifted in the Germany 30 here. We had this at one time was mixed long and short. It's now we're actually starting to see clients still long here on the DAX. They are. I'm sorry. We are seeing clients here a bit long on the DAX. However, if we move over here to the S&P 500, where we are seeing a split decision here, we've got clients 91% short on the S&P 500. But look at this; they're actually on the number of clients, we're actually net long on the S&P 500. So what does that mean? It means that we've got a split decision among clients as to whether the S&P 500 may continue to go higher or not. But the bigger money is telling us that people that when they're putting their money where their mouth is have been decidedly going short on the S&P 500. So that's quite significant here. The next thing I wanted to look at was what's going to happen in terms of commodities and how can this influence markets. Towards the end of last week, we saw with the big sell-off in crude oil hit resource stocks really hard. We saw energy stocks take big hits. We've seen mining stocks take big hits. And how does this play out into next week, and how does this affect some of the major indices? We'll start with looking at some of the commodity price action. So crude oil has had a huge sell-off. We are seeing here on the client sentiment, though, people are starting to go bargain hunting, and our clients have actually been net long. All clients 84% long. Top clients 59% long. This suggests that the top clients maybe are a little more reluctant to try try and step in and go bargain hunting at this point, because there's still a risk early on that the crude oil could still be volatile and this sell-off may not be completely finished. We've had we are getting into the point where we do have the potential for a washout. We've been steadily declining in oil, and as we've gone, the negative momentum has accelerated and accelerated, and then really been smashed down in the last few days. As we move into the early part of this week, there is the possibility there could still be a little bit of forced selling left. On Thursday, when we had the big 6% drop in WTI and Brent last week, the U.S. was closed, so margin calls in the U.S., because of the holiday, margin calls in the U.S. are going out a little bit later, so we could still see some forced selling and some mixed action to start the week in crude oil. At some point, it may stabilize, though, and we may see it start to bottom out. But here's the important thing. With the OPEC meeting showed that nobody's really interested in cutting production. They're all, rather than one person taking the first move and seeing somebody else step in and fill the gap they leave behind and lose share, they're all more interested in continuing the production levels, even if they're not making as much money. Clearly, it hasn't fallen enough that it's really hurting and really forcing shut-ins. So we could still see longer-term more weakness in the crude oil. We can't rule out a test of the $60 level for WTI and perhaps 65 for Brent. Currently we've got crude oil trading in and around 67. 70 has become a new lower resistance level. We're getting oversold on the RSI, very oversold, so we can see some trading bounces. Perhaps once some of this forced selling works its way through the market, we could see it bounce. But what's important is that crude oil, we may see stabilize at a lower level for a longer period of time. So whether that becomes a 60 to 80 channel or a 65 to 75 remains to be seen. At this point, it's still in a downtrend. We're still in the bottom. We haven't started to level off yet, but we could see quite a bit of volatility in crude oil as we move through the next few weeks, and people it starts to try and find itself a bottom, try and find out where it might actually get some support. The decline in crude oil has now started to impact other markets more widely, and not just energy stocks, but also other markets. So, for example, gold has come under a lot of pressure here on Friday the 28th. And it's starting to catch up to the sell-off in crude oil. Gold had been doing fairly well in recent weeks. The bottom has fallen out in the last couple of days. Here's the why, and why gold could be extremely active market right through the first week of December. One of the main factors driving gold is gold's acting as a store of value. It's also considered to be a hedge against inflation. When inflation goes up, gold historically has gone up. Now, however, we're starting to see that with the collapse in crude oil prices, inflation pressure is easing dramatically, perhaps even starting to raise the risk of deflation. What's happening? Gold is coming back down. There's two other big factors that could drive gold this week. First of all, on Sunday, we have the Swiss vote on what to do with their gold holdings. If the yes vote wins, the idea is to force the Swiss National Bank to stop selling gold, to call back all the gold that it has out on loan, and to increase the amount of gold that it has in its holdings. So that a yes vote would be seen as bullish for gold, or at least supportive for gold. A no vote could be seen as bearish for gold. We saw, even though the street is expecting a possible no vote, we saw with the OPEC meeting last week that there's a difference between speculating that something bad might happen and something actually happening, and because of that, it was after the OPEC meeting that we saw oil go down 6%, even though it was already down earlier in the week. So we could see gold potentially be volatile following the Swiss vote. On top of that, we have later in the week, we have the ECB meeting, and that one's quite important because a lot of people have been speculating that the ECB may come under more pressure to try and accelerate quantitative easing and its asset purchases before the end of the year. I don't think they're going to do it. I think they're going to punt that off till 2015. The reason is that in December, they have their second tranche of the targeted LTRO loans. They didn't do very much with it in September. They only did about 80 billion euros worth of loans. People will, including the ECB, will be looking to see is there more take up this time around, and what kind of stimulus will enter the market from that before they start ramping up further on their other asset purchase programs. So there's a possibility that the Swiss could disappoint. There's a possibility that the ECB could disappoint the people that are thinking they're going to come in with heavy stimulus in December. Either of those as a disappointment could weigh on gold. So on the other hand, any positive surprises could have a positive impact on gold. So gold is looking to be quite a volatile, active market right through the week. as I noted, what we've seen with the declines in commodity prices is that we've seen it impact some of the resource markets as well. In particular, we've seen it impact Canada, both in terms of the currency as well as in terms of the stocks. I'll just briefly show the stocks in Canada, which is a more heavily weighted to energy producers and miners, and what are we seeing? That in fact, when we had the rally here in Canada, peaked out at a much lower high than we saw in the U.S. or in Germany, and now we've seen it starting to roll over as we've gotten this impact from from declining resource prices, and we're also seeing it here. RSI has rolled back down as well. I'll also show the impact of the drop in oil prices on the Canadian dollar. So if we close out of the stocks here and we come over to US dollar CAD, which is right here, and we'll see that this is the move in the oil has had an explosive impact on the Canadian dollar. As it is, the Canadian dollar has been weakening for some time. This is the US dollar strengthening. Look at this. We had a big symmetrical consolidation triangle here, and kaboom, on Thursday, Friday, bang, bang. Two huge, huge days where the Canadian dollar has really dropped off hard. Upward momentum for dollar CAD picking up dramatically, and the loonie weakening quite dramatically. First resistance is here about 114.70, then about $115 even. Remains in an uptrend. CAD can remain under pressure as long as we have the oil price continuing to remain volatile and particularly under downward pressure. It's also a busy week for news in Canada. The Bank of Canada is having a meeting. People will be looking there to see will there be any change in their feeling towards interest rates. The Bank of Canada has basically been indicating they'd be on hold for quite some time to come. But in the last OECD report, they suggested that perhaps the Bank of Canada could move as early as May. On Friday, we saw the Canadian producer prices, basically the bottom fall out from under them. So there's certainly no pressure on the Bank of Canada to do anything, and particularly with crude oil prices coming down, inflation coming down, and the loonie coming down. At this point, it doesn't look like there's anything to really encourage them to move on interest rates, but we'll see if they actually say anything. Plus, the Canadian employment report comes out on Friday, same time as the U.S. employment report. That usually drives action in trading in the loonie as well. Sticking with resource markets, I just wanted to highlight Australia here for a moment. In the case of Australia, where they're very sensitive to China, and the recent PBOC interest rate cut in China has raised questions about what's going on with the Chinese economy, how badly is it slowing, and could there be more rate cuts, and what does this mean for Chinese demand for resources? One of the only real data points we get from China this week is the purchasing managers indices, both the service and the manufacturing. People will be looking to that for signs of what does that mean for China demand. Interestingly enough, as we head towards the end of the week, we're looking at copper is starting to break down pretty substantially here. It's been in the downtrend for much of the year, but kaboom, the bottom's fallen out under this on Friday the 28th. It started at 295 and just kept right on going down below 290. This is a very, very major breakdown for copper here, and we'll just go back and actually show how long it's been. Look at this. This is a huge breakdown for copper. We're now trading at our lowest level of copper since the middle of 2010. So a pretty big breakdown there going on in copper this week. And so what is this meaning for Australian stocks? Well, we're seeing that as we saw with Canada, Australia's market topped out early and at a much lower level than we saw in markets in Germany and the United States. We saw it swing up here. We had a rebound attempt here. RSI remained below 50, broader downward momentum intact, and we're seeing it start to sell off again. So less of the oil impact on Australia, but more the metals, the falling gold price, the falling copper price is weighing on Australia. We may also see that play out in trading in the Australian dollar this week. So I'll bring up Aussie dollar here. And as we see here, we've seen Aussie had a big sell-off in September, had paused through October. It's been choppy, but kind of working its way lower through November, and is starting to break down right into the end of the month. We're seeing RSI remains below 50. It's generally in a downtrend. This week for Australia, in addition to the news coming out of China, we have an RBA meeting. The recent talk from RBA officials has still been dollar negative. They've been still trying to talk the dollar down. We'll see if they try and do it again in their statement. And also during the week, we get a number of other economic reports out from Australia, so keep an eye on those. We could see those impact Aussie trading quite significantly. But most importantly here, it's been trying to test the 85-cent level. If it does start to break that, then the next measured support on it would be in and around 83 cents. On a rebound, first resistance may be up here around 85.55, then around 85.60, and then 87.20. So Australia does remain in a downtrend here, and the Aussie dollar could be impacted by either resource news or by economic news from China, Australia, or elsewhere. The one last thing I did want to go back and talk about was the ECB meeting with the ECB potentially holding off on any more stimulus until next year. I just wanted to so what this could mean for the euro dollar. The euro dollar has been trying to stabilize in recent weeks here in a channel between about 123.70 and 126, with an intermediate level here in and around 125. RSI has remained stuck below 50, meaning that the broader downtrend for the euro dollar has remained intact, and we're just seeing consistently lower highs and lower highs. So it's under distribution here. If the ECB comes out with more stimulus, you could see this floor get taken out and it possibly drop lower. The next measured support is in and around 121 and change. However, if you did see the ECB hold off, that actually could be supportive for the euro. You could make a case for a possible double bottom here, and that could help. But overall, though, I suspect you may see it continue to trade in this sideways channel here for some time as it continues to digest things. So basically what we're looking at is there's the potential for a lot of action around the world this week, a lot of action in indices, in commodities, as well as in currencies, with a whole number of players a whole number of factors playing off against each other potentially, a whole ton of news coming out that could move the markets, that could impact things. It looks like we could be in for a really wild trading week to start December.